Hi, it's great to have you back joining us for another episode of our investor education series. It's my pleasure today to be joined by Matthew Ward, a friend and colleague who is at Cadron Capital Partners. Matthew, why don't you tell everyone a little bit about yourself and about what you do?
Yeah, Chris, really appreciate you having me on. So my name is Matthew Ward. I'm a venture partner at Cadron Capital Partners. We're a VC firm in Northwest Arkansas. A little bit about me, my role with the firm. Typically, I'm leading sourcing and also due diligence with the companies we invest in. Type of companies that we look at typically between seed stage to Series B. So typically they have revenue, looking to be profitable. Check sizes, we write between 100,000 to 500,000. Typically in companies that are tech or tech enabled. We also look at companies that have high gross margins, solid year over year growth, companies that are able to scale, grow, and we can have an exit there. Really, if it fits within that criteria. And also to add, we have a criteria of revenue. So 2 million in ARR, which is annual recurring revenue, or 4 million in service revenue as well. So whenever we source companies and they fit that mold, we'll have a conversation with them and go from there.
Awesome. So I guess the first initial question then is, you talk about finding these companies. Where do you find them with things like accelerators, pitch events? How do companies get on your radar so that you can have a chance to invest in them?
Yeah, so accelerators and pitch events are great ways to source companies. There's a handful that are really high quality and credible. Whenever we look at where to find these, like what are the characteristics, we look at people and the history of success. So within an accelerator, there are different type of people. There are people running the operation. There are the ventures, the mentors, customers, investors. We look across the landscape and make sure that there's credibility and there's value being given. So for example, on the venture side, are high quality ventures being sourced? Do they have a history with the accelerator of having outcomes with the accelerator? So think of like capital raised, a number of contracts secured, startups that have relocated, looking at these important outcomes there. And then also looking at customers and investors. Are customers looking to do, a proof of concept for a pilot with these ventures? And are investors looking to write checks within these ventures because they know they're quality companies? And then also history of success with the accelerators, looking at how long have they been around? How many cohorts have they had? What does alumni success look like? That's what it looks like on the accelerator side. And then for the pitch events, sort of the same criteria there. Like, who are the people running the pitch event? Are they bringing in very credible ventures? Do they have investors that are present, that has an investment thesis that matches up with the ventures that are pitching at the event as well? Those are some areas that we look at, and just to make sure that we are dealing with ventures that can drive returns for our limited partners, people who are putting money into our fund.
Great. Now, when you look at these accelerators, some of them can be really, really well done. All the glitz and glamour and just looking picture perfect. How do you differentiate between kind of the hype and the ones that actually have quality programs? Like where do you do that?
Yeah, so first, going back to alumni outcomes, how much capital are they raising? What sort of contracts are they getting? What's happening to the startups once they go from A to B? And then after the program, what does success look like? We look at that first. And then another piece of advice I would give to investors is be active in the accelerators. Whether you're a mentor, whether you're doing a workshop there on a panel, having surface area coverage with these people that are involved in the accelerator will give you a better understanding of whether the accelerator is credible or not. And then another great indicator is post-program support. If an accelerator brings on ventures and then just kicks them to the curb after graduation, it's not a great look. So the accelerators that we get deal sourced from, the ones that are still providing connections, still providing advisory services, we've seen a really high correlation with those type of accelerators producing really strong ventures.
That's really interesting. We did a session on angel investing and talked about how you can be a really active or passive investor. And I think that's really interesting that you brought that up. That you can be active in these accelerator cohorts as a mentor. You can learn more about the companies. If you choose to invest, you've got a little bit more background that you've worked with. That's a great approach to have. Now with these accelerators, like let's say I'm an investor, how do I get an invitation to even come to some of these demo days or demo nights, and how do I get on their radar for like close room deals and things like that?
Yeah, so previously I used to run a pretty marquee accelerator in Arkansas that was focused on AI and some other areas. One of the things that really stood out to me where I wanted to invite somebody or have somebody included is them providing value for the program. So
Mm.
if they're a mentor providing really good knowledge or connections to the ventures, if they're running a workshop showing really good insights for what's going on in the space, and also people that are just looking to be helpful in general. It doesn't have to be directly to the ventures. It could be providing connections for the people running the accelerators. It could be being a people connector from venture to venture or an SME to a customer. Just showing value is a great way. And then another way there is to be present. So something that I've noticed in the ecosystem is I see sort of the same people running around and smiling and showing
Yeah.
value. And that's where I want to help those people. Those are the people who are really the catalyst behind what we're doing. And that's a few of the recommendations I would give.
Yeah. That active engagement probably makes all the difference in the world to just being on people's radar. Because honestly, if you don't speak up and if you're not involved, you probably won't get noticed in the large crowds that can be at some of the demo day type events. So you've really got to be eager and forward thinking. So if you're evaluating the accelerators for which ones are a good fit for looking at potential investments, then how do you evaluate the individual startups that are participating? How do you look at them when you attend something like this and try to discern like this one would be good fit for me, this one wouldn't?
Yeah, one of the key indicators there is what happened during the accelerators, what milestones were accomplished. So that could be they raised a round of capital, they were able to secure an enterprise contract, maybe even just solidifying their sales channel strategy. They got a lot of good feedback from customers and mentors they met with, and they decided, okay, this is what we're going to go with. And it's funny. We actually, in one of the accelerators we're consistently investing in, met with the founding team. And what was crazy there is they secured an enterprise contract that was in the 8-figure range.
Wow.
Like, how does that happen? So what happened there is they're very active. They went to a networking house. They met someone at like a yoga studio, like very random, but this person was a mover and shaker in the ecosystem. And what happened is this company explained like who they are, what they're doing, their missions, all of that. And this person was so impressed, they made an introduction to a channel partner that sold into one of these large enterprises. And a channel partner is just someone who's already selling into a company and is taking somebody else's product or service and sort of packaging it there. But what was really impressive to us is they were only in this accelerator for a finite amount of time. They went out, they networked, they made business happen. And that was one of the main reasons, not the only reason. We take a comprehensive approach, but that was one of the main reasons why we decided to invest is, man, they came into this area, they made it happen, and they're able to drive revenue there. So
You said an 8-figure deal?
8-figure deal. It was over
8-figure
multiple
deal
years, but yes. Yeah.
In a 10 to 16 week span of being in an area for an accelerator. That's pretty impressive.
Yeah, and that's been something that's been really interesting is with more of these successful companies, they seem to be really good at networking, which makes sense. But you look at like meaningful mentorship, connections and so forth, you just see there's a correlation between people who are out there meeting people versus the people who are a bit more reserved. So yeah, interesting.
Great. Some good feedback on how we can evaluate potential accelerators as an investor and individual startups in those accelerators. I love it and appreciate that. So let's talk syndicates now. Can you explain to our potential investor audience what is a syndicate?
Yeah, so a syndicate is a group of investors that pool their money together and invest in a deal. Typically, there's a lead within that who manages terms and also manages the investment process. The strength of a syndicate is you're able to get into deals that you may not have been able to in the past because of the pooling of the money allows for a bigger check to go into a startup.
And what's the most effective way to get plugged into something like that as an angel investor?
Yeah, I think one is providing value. So if you're providing deals to others in the community and they're able to get a financial return off of that, they're definitely going to want to show reciprocity there and have you involved in other deals as well. Also, kind of an underrated tip is ask for feedback in general on deals that you're looking at. I've noticed that people enjoy being a mentor. They want to be helpful. So if you're doing it not in a distasteful way, but just looking for helpful feedback, typically they'll want to help you out and be involved with what you're doing.
So joining some of those angel groups and things like that, like that's key then to this, is you can't really approach it in a lone wolf mentality. I mean, I guess you could, but there's just more safety in numbers. You can rely off the insight of others, and that really probably helps with deal flow and seeing better investment opportunities as well. How do you approach sort of this networking side of angel investing then, of kind of meeting other investors and angel groups? How do you kind of feel them out and see what they're all about?
Yeah, I think it's kind of like dating. You don't want to come across as too desperate or dominating the conversations. You want to listen and be authentic. I think that's really important because people like to talk about themselves typically. And there's a saying, you have 2 ears and 1 mouth. You should probably try to stick with that.
Yep.
Also, what's really important is being educated. When you're, whether it's real estate or whatever, being able to talk in the same terminology is really important. That'll build credibility. So being able to, there's a book called Venture Deals that talks about different terms in VC. There's, with Startup Junkie and these other entrepreneurial support organizations that have videos that you can check out to learn more. Being able to come in prepared to talk in the same language as other investors is really important. And also just showing face, being around. Like you said, if people start to recognize you more and more, it's helpful to have a level of understanding with each other that you're involved, you're a player, and be willing to help each other out.
Yeah. You mentioned that kind of feeling out an angel group like that is like dating. So let's say it's my first date then, and I don't want to come across as the awkward guy or like give off weird vibes or raise red flags. What are some things that I should avoid? Like you say, do not do this if you're going to be successful.
Yeah, one of the biggest mistakes is overcompensating. So don't try to dominate the conversation, like listen in, gather all the data that you can. And once you've been around a bit more, then start to give more input. But that's one recommendation, is don't dominate the conversation. Also, there's this concept of givers and takers. Don't be super transactional, like be there to provide value, listen. Yeah. There's a saying, the takers are people who are just looking out for themselves. Short term, they gain, but in the long run, it doesn't turn out well. Versus with the giver, it's sort of the opposite there. In the short run, you may be giving out more value and so forth, but in the long run, people want to be associated with people that are helping them out as well.
I love that advice for being in, approaching a syndicate group and an angel group, to be genuine, be the helper, be the one who contributes and not just the one who's trying to get out of it. That's all great advice. All right, so let's talk about some of the ways technology is kind of changing the investment game and how you can access some of it online. Explain to us what a tourist deal is.
So a tourist deal is a deal that attracts people who may not be experienced as an investor or just may not have an understanding of the space. So when you think of a tourist going into a new city, they may be very excited about a lot of what's going on. It's kind of the same concept here. You may be bringing in someone who doesn't have the experience in the space or just maybe a new investor, and everything looks exciting. I want to invest in everything. I want to throw all my money in. In a tourist deal, some of the characteristics there are, it's in a trendy space. So think of AI, Web3, cannabis, etc. There's low minimum investments there. And then also maybe like celebrity endorsed. There's high guarantees, very low to no risk. So when you're going into these investment platforms, you have to be cautious about what you're doing because you're not in a fully structured group.
So then how do I sniff out the good from the bad? How do I tell like what's a solid online platform versus what's going to probably try to put me through like a tourist deal?
Yeah. So first, start small and diversify. In general, with this asset class or way of investing, more than likely you don't want to invest in just one or two. You want to invest in a decent amount so you have some diversification of your risk. But then also research the platform. You can find a lot of information on these different platforms on what does their due diligence process look like. And when I say due diligence, it's research on the companies. What are the requirements for like documents that are on there? What does quality look like? Do they have any testimonials of ventures that have gone on to grow and scale? Those are a few pieces of advice I have there. And then in general, when you're looking at a company, do research outside of the platform as well, whether it's looking at their LinkedIns, going on, let's say, Crunchbase or PitchBook to get more information about their past raises. It's really important to not just rely on the platform, but also do research outside of it as well.
So then when and how does like direct investing compare with like an online investing platform? Who should do one or the other?
Yeah. At the end of the day, you can do whatever you want. But when I look at online investing platforms, I think about people who may just be starting out with angel investing or the convenience aspect of it. Because when you're on these investment platforms, it's much easier to have a selection of deals versus when you're doing direct investing, maybe looking at one deal at a time and spending time on sourcing and due diligence there. But also within the investment platforms, with seeing more companies, you're also getting a more curated way of doing due diligence on the platform. And also there's lower investment amounts. So you may be able to get more investments in different ventures. However, some of the risks with that is there may not be as good quality control as direct investing with companies you're looking at.
So if that's who a good fit is for an online platform, direct investing is good for who? Like what type of investor and how would they interact with that better or differently?
So typically with direct investing, it's going to be someone who has expertise in a certain domain or just has experience as an investor and they sort of graduated from the investment platform. What's really great about direct investing is you get more detailed information when conducting due diligence and you control more of that process.
Mm-hmm.
And you get more access to the founder as well. On the online investment platform, you may not have as much access to the founder. Some of the downside could be it's more resource heavy. So instead of the platform doing sourcing for you, you're having to go and find startups, get to know them, go through due diligence and collect all the documents yourself and do quality checks. So definitely more resource heavy. And I think a good middle ground there when you look at direct investing versus online investment platform is angel groups. So with angel groups, you still get a good cadence of flow of startups that are being shown to the group, but you also have the structure and expertise of the group of other angels, the leaders who are leading the group. And you get access to how they're doing their due diligence and getting sort of a framework of how to direct invest. So when deciding between the two, let's say you don't want to do the online investment platform, it's not up to par for you, but also direct investing seems really scary at the time.
Yeah.
Sort of cut the middle ground, go to an angel investment group and see what that's about.
I like that spectrum of convenience, a really big pool, sort of ease of use and interaction, kind of more passive on the online platform side to the more hands-on, more active, direct investing side, more engagement with the founder. And then in those angel groups, you kind of get the best of both worlds.
Exactly.
You get a good deal flow. You get colleagues to look at it. Probably not as many people as on the online platform, but still some good expertise in the room who can help you vet and parse through all the different details in a deal. That's a great way to kind of explain the lay of the land there from online through direct investing. All right, so now let's talk about your deal pipeline. What does it look like? How does the whole thing flow from start to end on a deal?
So with Cadron, from initial contact to the investment decision, is typically a 2 to 3 week decision. We're pretty efficient. However, there can be some variability there depending on cadence of communication and availability of data. So how it works for us is first we have the initial call with the founder. We talk through who we are, what we do, the value that we provide to founders. And then we flip it on them, understand more about who they are, their background, the company, the traction, all these really important data points. Once we hear all of that, what we'll do as a group is we'll caucus, we'll talk through all of that data and decide if we want to go into due diligence. If we decide to go into due diligence, we'll get access to the founder's data room. And what we'll do there is have sort of a back and forth that could be through email or Zoom, just asking questions about clarifying data in there, asking questions about, the trajectory of the startup. There's a lot of different questions there. We go through that sort of learning process. What I'll do is once we have all that together, I'll send an investment recommendation to our general partners of the fund, so the people who are running and managing the fund, give them a recommendation to invest or not invest, lay out why not. And if they review that and say, yes, great, let's go on to the next step, then what we'll do is put together an investment memo. And how an investment memo works is it'll have information about the company, the round details, and then sort of the justification behind why we're recommending to invest in the company. And that'll go to something called our IAC, our Investment Advisory Committee, who are full of experts within investing and certain subject matter experts, domains. They will review it, ask any questions they have, clarify the rationale behind investing in the company. Once we go through that, if everybody's happy and we want to proceed, then we'll send to the company, hey, we want to invest in your company. And that's also really rewarding to send that message over.
I bet. And so then as an angel investor and an individual investor, when you're going through this pipeline, can I sort of assume that anybody who's getting VC support that's gone through a pipeline process like that, like someone has done a good amount of due diligence on them, I can rest a little more assured? Is that how it works?
100%. We have something called a fiduciary duty to the people that invest in our fund, which means we need to maximize returns for them because they've trusted us with our money. So just to put some numbers out there, I would say it's about around 100 deals that we see before we invest in one.
Wow.
And we get a lot of inbound through email, events, programs. We're very involved in the ecosystem, and we just get a lot of people doing cold outreach, which is completely fine. But we are very methodical in the companies that we invest in. So maybe different across other firms, but if you're able to get an investment from our firm, just know that we've been very thoughtful and had a lot of people involved just to make sure that we're choosing the right ventures.
So then an individual investor shouldn't feel bad about passing on deals if you're at least 100 before you're ever probably putting in on one.
No, 100%. You want to be patient and have conviction as an investor. There is a lot of uncertainty in general with ventures. There's a lot of stuff that can go on from the macro of regulations, politics, et cetera, to the micro. Are you hiring the right people? Do you have the right strategy? So definitely be rest assured if you are having a hard time of pulling the trigger on the first investment, that's completely okay.
Yeah, that sounds like something everybody struggles with.
100%.
That's good. So Matthew, let's take this apart piece by piece. Let's talk about the things you're looking for when you're filtering and screening startups. Let's start with the pitch deck. Yeah. What are you looking for, the signs of a good pitch deck when you want to invest?
That's a great question. So we see a lot of pitch decks, hundreds of them. So when we're doing the scan, one, is the deck simple and short? We see a lot of decks that are like 20 plus pages, and we start to glaze over our eyes and we're like, okay, we need to move on. This is too much. If they can't communicate it in the deck, it's going to be hard for them to communicate to investors, customers, etc. Two is the team. Looking at the team's background, have they already done this in the past, whether it was in corporate setting or maybe they've already done a startup previously and had a big exit off of that? We like to see that. Now, also, are they adaptable and can they recruit the right people later on? Traction, what does revenue growth look like? Who are they partnering with? What are some of these data points that we can look at and see, wow, like they are really ahead of the curve of the stage that they're at as a company? And then also market size. What's really important whenever you're doing venture investing in startups is the market needs to be big enough for it. If they can get a piece of the pie, that'll create a big enough big enough return for the investors involved in the fund.
So let's say you're looking at the pitch deck and engaging with the founder. What are some initial red flags that are just a no-go for you? You're like, this is a bad sign.
So first, they're not solving a real painful problem. It's something that's maybe convenient for them, but they haven't gone out, done customer discovery and talked to people that may be customers. That's one thing. Another is looking at the deck and it's way too long, full of technical jargon, and our eyes just start to glaze over. That's another side of it. With the market side as well, if it's a really small market, and even if they captured all of the market, it can provide a return enough for us, which is fine. Like there's a lot of great businesses that don't really fit into the angel investing mold. Another piece is lack of traction, or they're not showcasing the traction. So maybe it's, hey, we got this really cool product, we raised some money, but we don't have any customers. There's no foresight into customers or revenue. So is it more of like a science experiment, or how do we play into this as an investor? Those are some of the red flags or sort of no-goes that we see on decks.
And do you have any go-to questions that you pose to like founders or their teams to really quickly kind of assess, like, can they pull this off? Are they Are they competent? Are they credible? Like what sort of things would you ask them?
Yeah, you're spot on there. So some of the areas that we ask questions around are like competitive landscape, market, and the problem. So the problem is, what is the problem, and why does your team have the right to win in that landscape? So that backing it into understanding like who are the founders, who's on the team that can solve the problem, and looking forward, like can they recruit the talent to solve that problem? And also looking at the problem, it allows us to understand if they've gone out, talk to customers, or if they have a background within that problem to where they can understand, solve that pain point there. The landscape, asking them, what does the competitive landscape look like? And what makes you different than those other competitors? That's also a really big deal too. If they know who the main competitors are, that shows us that they've done their research or they come from the space. And then on the differentiation side, understanding how their product is different as well is really important. And then last, with the market, how is the market structured? So whenever they're selling into an enterprise, do they understand who the buyers are? Who are the influencers? Who are the gatekeepers? If they understand how to go through that methodical process and drive sales, because enterprise sales can be very difficult, that's a really positive indicator for us.
So I would imagine then that someone who claims like, oh, there are no competitors, or, oh, it's just going to sell itself, like that's problematic. They need to show some sort of competency in understanding the lay of the land, who's out there, who's even doing something remotely similar, so that they know who potential competitors might be.
Exactly. And just to touch on the no competitors, we've heard that a lot. Whether it's an alternative or seeing what they're currently using, they're using something, even if it's not within the same domain that you're in, they're using something to solve that problem. So 100% agree. You got to ask the right questions to get to the value prop there.
Yeah. So then beyond the pitch deck and the founder and his team or her team, how do you assess the product market fit and whether or not there's a need for the solution they're proposing?
Few ways. So on the quantitative side, we'll go through their financials, their data, and look at different areas such as, the customers that they're already selling into. Are they able to upsell into those customers? When you look at something called a Net Promoter Score, which how that works is you ask a customer, would you recommend this solution to a friend or family member? Scale of 1 to 10. It groups in 3 different groups from promoters, passive, and detractors. If you have a high score on that, it shows that they're satisfied with the solution. That can be a really good indicator as well. Also looking at very simple revenue and user growth. Is that growing consistently over time? And then on the qualitative side, is there word of mouth? Are you not having to spend a lot on marketing to get more customers? And that could be reviews, testimonials, friends and family. That's a really great way to fire up the engine on your ventures, having people talk about your product without you having to go and spend those marketing dollars.
Yeah. Having people talk about it and having the revenue side of having them actually be paying for it probably really provides some good early on validation that this is an idea worth investing in, worth looking at. What about when you consider like their unique value proposition? How do you assess whether it's genuinely unique and solving a problem from a different angle instead of just, one of 10 different solutions in a bloated area?
Yeah, I think understanding the competitive landscape is really important. Like, who are you comparing yourself to? Why are they not able to solve the problem as well as you are? That's really important. Also, the team and their background. If they've been working, let's say, in this industry for cumulatively over 100 years with the founders, and they really understand this problem compared to others, that gives them a unique sort of understanding of how to structure their value proposition and outcompete competitors. Also, what can be really important there is getting feedback from people that are already in industry. That can be people on your investment board, or for an angel investor, that could be your network, whether it's somebody working at, if it's a prop tech company, talking to someone at a brokerage firm, or maybe it's a shop that helps do development for prop tech companies, just getting their feedback on whether it's like the technical build or their strategy. That allows you to get more insight as well if it's really unique or not.
Awesome. So we've talked about the pitch deck, the founder, the product market fit, whether or not it's unique. As you're looking kind of at this deal flow, And you've mentioned all these positive things you're looking for. Like I hate to put you on the spot about this, but what's like a horror story of a deal gone bad where you're like, man, I wouldn't have done it that way again?
Yeah, there's a saying, do as I say, not as I do. And we've talked about some of these major points of being comprehensive with your due diligence and going through that whole exercise. Well, a while back, I was looking at a deal, definitely would say had FOMO on it, very hyped up deal. You had top tier team from places like Yamaha and SpaceX and some of these
Wow.
really big companies, like very legit. They've solved problems that have been similar to this before. You had investors on the cap table that are household names. Time called it like an invention of the year, and they actually broke a record for amount of investment on a crowdfunding platform. So
Wow.
I was like, wow, like this is pretty legit. Like they got something going on. My mistake on that was I was not staying objective. I was blinded. So when I was going through due diligence, I was not as detailed as I should have been. And there were some different points where I should have asked questions about. Like they kept delaying their product launches and they continue to have unreasonable assumptions based off assumptions they've made in the past and not meeting their goals. And to tell you how exaggerated it was, we signed a safe that did not have a cap on it. So typically whenever you're looking at a safe, I'm sure you talked about in this other modules, but it's a type of deal structure. Usually early stage companies use it. It's the easiest way to do it, low admin cost. Usually you want a cap on it, so it creates a ceiling on the valuation that you get in as an investor on the next round that they raise. Well, we signed an uncapped one.
Wow.
Just because of how much hype was around it and projections and so forth. So they actually went out of business. They had a hard time keeping up with their business fundamentals, and it was sort of a situation where they had to keep raising to stay alive. They couldn't keep up with sales and expenses started to get bloated. So recommendation is to follow what I said earlier, like do thorough due diligence, stay objective, have your investment criteria, and really make sure that you're honed in and have conviction, not being swayed by sort of FOMO or hype behind the company.
I love it. Thanks for taking the time with us today to talk about how you source deals, how you vet startups. I know that the investors across Arkansas and beyond are going to be really interested to see kind of how you've approached it and how they can use some of those insights in their vetting and sourcing of investments for themselves. So thank you very much, Matthew. It was great having you here today. And we'll probably have you back to talk more terms and deal flow and all that at some point in the future.
Sounds good. Thanks for having me.